Hello, everybody. I'm Harry Margolis, and I'm here with my partner, Sarah Hartline, to talk to you about the whole new world of the Massachusetts estate tax. So welcome. I'm going to start by just talking about what we're going to do today. So Sarah and I will be something of a tag team. I am going to talk about the basic changes. Sarah's going to, that's really mostly in the threshold. Sarah will then talk about a significant change with the towards the treatment, trying to find the right preposition, but a big change on the treatment of out-of-state real estate. I will then talk to change in how gifting, taxable gifts are going to work, and then Sarah will get to the maybe the most important question. What does this mean for everybody in terms of their planning, both if they don't have an estate tax plan and if they already do have one. And then we're going to go to questions and answers. We have a bunch that we've already received over the transom, and then you can also type those in. I believe where it says, maybe where it says chat. I actually don't see a Q&A, or maybe there's a question on my screen. I don't see a place for questions on GoToMeeting, so maybe under chat. And we will stop exactly at 1, so everyone can get on with their day. Whether we've, I guess we have no questions, we might stop before that, but if we have a lot, we will stop then. You should be aware that we are recording this program, and that we will send you a recording. So if you can't stay for the whole program, that's fine. You'll get the recording. That might take us about a week, and we'll also post it on our website under the News and Events tab. And just be aware that feel free to explore our website at margolisbloom.com. We have a lot of resources there. Recordings, videos, and legal guides that we hope will help answer your estate planning questions. So, Sarah, did I miss anything on the introduction?
No, I think you had everything.
Okay, very good. So let's talk about what changed. The big change is pretty simple. The threshold for Massachusetts estate taxation increased from $1 million to $2 million for a couple who does the kind of basic credit shelter trust planning, which we'll discuss later. It goes up from 2 million to 4 million. And this is effective for all estates of people who died going back to the first of the year. As you probably know, the estate tax return is due 9 months from the date of death. So some of those states have already filed returns and pay taxes. And if you're in a situation like that, what you do is you file an amended return, and the state will send you back your funds, whatever you paid to date. So there's two ways that the legislature has changed the threshold. The first is that they've applied a credit to all estate tax returns of $99,600. So, which is basically the tax on it under the former tax code, which really hasn't changed. Is what would the tax be? That's what the tax would be on a $2 million estate. So what this does is, in addition to exempting all estates under 2 million, it also reduces the estate tax on larger estates. So even if you have a $10 million estate, you get $100,000 or so off the estate tax. And the other thing is they added a clear statement that any estate with a federally, how do I say this? The statement is that basically that any estate under $2 million is not taxed, but it ties it to the federal estate tax. So it says that any estate with a value of with a federal estate tax value of under $2 million is not taxed, and we'll get into some of how that works when we talk about gifting kind of what the definition of estate, its significance. So that's the basic law, and that basically that we're up to $2 million. Every estate gets this almost $100,000 estate tax reduction, and there's a clear statement that no estate under $2 million should have to pay a tax. And I will turn it over to you, Sarah, to talk about the change in how out-of-state real estate gets taxed.
Great, thank you. So yes, so I'm going to be talking specifically about, so this is about Massachusetts residents who have real estate outside of Massachusetts and how that is taxed. And in order to understand the new law, it is helpful to understand the prior law. And so under the old law, the Massachusetts, the way the statute was written was that the tax was computed based on the federal taxable estate, which included the full value of real estate both inside and outside of Massachusetts. There is a credit for taxes that were paid in another state. So if you had real estate in New York and you paid a separate New York tax for that real estate, you'd get a credit. But assuming that there was no tax in that other state, the way that the law was at least written was that all of that non-Massachusetts property is going to be treated in the same manner for tax purposes as the Massachusetts property. So all of it gets added together and taxed. The next important thing to understand is the 2016 DeSori case. So this was a case where a taxpayer argued, a Massachusetts taxpayer argued that this law, the old law, what it purported to do was unconstitutional because it was, in effect, Massachusetts taxing out-of-state real estate, and Massachusetts did not have the authority to do that. They didn't have the ability to reach and tax that out-of-state property. In that case, although there wasn't a formal holding that that was unconstitutional, the Department of Revenue did not dispute the argument that was put forth through by the taxpayer. So basically, after 2016, consistent with that DeSori decision, the popular practice and what we did at our firm, and what my understanding is that most other attorneys did as well, was to list that non-Massachusetts real estate on the estate tax return, the Massachusetts estate tax return, but it would be listed with a $0 value. So basically, there would be no tax. If you had as an example, if you had a Massachusetts property, Massachusetts estates of 1.5 million, and you had a Maine property of 1.5 million, you would list the Maine property as having a $0 value, and so you would just be taxed on the Massachusetts assets on that 1.5 million. So with that in mind, the old law, the 2016 DeSori case, now what the new law is doing is basically a middle ground between those two. So unlike the old law, it's not going to tax these out-of-state real estate at full value, but it's also trying to basically react to the DeSori case and increase so that somebody that does have out-of-state real estate is going to pay more tax than if they didn't have any out-of-state real estate. So the way that that works, and I think, I don't know, Harry, if you want to go to the next slide, I think there's an example. Oh, here, the example is right here, sorry. So the example is that, so again, in an example where you have 1.5 million Massachusetts property, you have a $1 million Maine vacation house, and so you have this $2.5 million total estate. What the new law says is that you calculate the estate tax on the 2.5 million. So what would it be if it was all Massachusetts property? But then you reduce it proportional to the percentage of Massachusetts property over total estate. So in a simple situation in which, you know, the Massachusetts property is 1.5 and Maine is 1.5, you calculate the tax and then you split it in half. So you do half of that. in this, so here's this tax calculation is that on $2.5 million Massachusetts estate, it's $39,000. But because 1 million of that is mean, you reduce it by multiply by 0.6, and so the actual tax due is $23,400. So still a tax due. It's still more than if you just calculated the tax on the 1.5 Massachusetts, because of the fact that you're because the Massachusetts has this sliding scale, so you're being taxed at a higher rate, even though you're only even though you're reducing it to just the Massachusetts property. So it is this middle ground between the two. It's important to note that is the way that Massachusetts has been, even under the old law, it's the way that Massachusetts has been taxing non-residents that have Massachusetts property. So if you were a Maine resident with $1 million and there's no Maine tax due, but you also have $1 million in Massachusetts real estate, you have property on Cape Cod, in that situation, that Maine resident would still have to pay a Massachusetts estate tax under the old law, and which would be calculated as the full value divided in half. And then under the new law, that non-resident is still gonna have to pay a tax, assuming that the total of assets is now over 2 million. So you have to add the out-of-state real estate, add the Massachusetts real estate, and see if it's over that $2 million threshold.
Okay. Okay, very good, Sarah. So I'm going to talk about a bit about gifting, and I'm also going to go back to the old law to talk about how that worked, and then how the new law works. And the I also just want to add something about the kind of basic structure. A lot of people are talking about the new estate tax getting rid of the so-called cliff. And what the cliff was that at the $1 million threshold under the prior law, you were subject to a pretty high tax rate, kind of between 1 million and 1.1 million of 40%, because it was based on the federal tax code. And so someone had a $999,000 estate, they would pay no tax, but if they had a $1,050,000 estate, they would pay $20,000 in tax. And that seemed like a pretty kind of almost a penalty for just being over that threshold. So, but under the new tax, you're just taxed if you're over 2 million. You're taxed at the marginal rate under the Massachusetts state tax for the excess dollars, which I believe is 7.2%. They have that rate, so which is much lower than the old 40%. So that's getting rid of that so-called cliff. But gifts had under the old law had a unique impact on the Massachusetts estate tax. So as you probably know, you give away $17,000 per individual per year. You don't have to file a gift tax return. If you give any individual more than $17,000, you are supposed to file a gift tax return. It's pretty irrelevant for the vast majority of people, because until you give over $12.9 million worth of tax gifts, you don't have to pay any tax. But on the federal side, what happens is that your taxable gifts get calculated back in when you die to determine whether you've exceeded that $12.9 million threshold. Massachusetts always worked differently. So there's no Massachusetts gift tax at all, no Massachusetts requirement to file a return. But but what you did have to do under the prior law, and potentially under the new law, is calculate in the taxable gifts and determining whether you exceeded the threshold. So in our example, let's say someone dies and they have an estate value of $900,000, but they made $300,000 of lifetime taxable gifts during their life. And so that adds up to 1.2 million. That was over the $1 million threshold. So they had to both file an estate tax return and pay a tax. and the tax was based on 900,000 of their estate, their estate value. So they didn't pay a tax on the 300,000, but the 300,000 triggered a requirement to pay a tax. So that's how the gifting worked prior to January 1st, and I think it was unique in the country in terms of that impact. So our reading the new law is that there's no tax now. So if you have an estate that's say 1.9 million, but you gave away 300,000 during life in taxable gifts, so it adds up to 2.2, you don't have to pay a tax, and that's for two reasons. One, the bar on taxation of estates under 2 million, though there's some debate about how estate is defined there, but there's another reason that you don't have to pay a tax, and that's because of the credit. So if the tax is calculated on 1.9 million, then there's the tax on that. If you look at the Massachusetts tax code, it's going to be less than the $99,600 credit. So if you calculate the tax and then apply the credit, you zero out any tax due. So what this does seem to do is totally exempt quote unquote deathbed gifts, because you can make a gift the day, week, month, whatever before you die. If the gift is completed and it brings your estate under $2 million, your estate shouldn't have to pay a tax. Now, of course, the tax rate is around 7% then instead of 40%, so you're not saving quite as much as you used to under the old tax code. But it seems like a big change in how gifting works and its effect on taxation. But you still might have to file an estate tax return, because while the provision in the code in the new law that says that $2 million estates don't have to pay a tax doesn't say that they don't have to file an estate tax return. So you may still be in a position where your estate's under $2 million, but if your gifts push the estate above $2 million, then you might have to file a return but not pay a tax. Now, there's kind of two different situations here. One is that technically there's an estate tax return due, but there's no tax and there's in effect no penalty for not filing the return, because the penalty is a percentage of the tax due. But so maybe you just don't file, the executor just doesn't file a return because it doesn't seem worth the trouble. The problem, I think, has to do with real estate. So when you have real estate in your estate, in order to clear title, you have to file an affidavit that there's no estate tax due, and it generally would say that no return needs to be filed. And that might be fine, but it might not be fine for anyone looking at title. So title examiners or closing attorneys may require to be certain that there's no estate tax return due if you can't say that the state for this purpose is under 2 million, may require returns even in these particular situations. So that, I think this is an area that's going to have to play out over the ensuing probably months or a year or so to see how that's affected. So, okay, and that's the gifting situation. I hope that was a little clearer than mud, but we can always answer some questions later if it wasn't. And now a question of what we should all do in light of this new law. Sarah.
Great, yes. So so we've gone over the basics and what does this mean for you. So a few different categories that you might fall into. The first category is that your estate is well under 2 million and you may not need to worry about estate tax planning. So that's one category that that you might fall into after watching this. But I think one important thing to flag is that unlike the federal estate tax, this new Massachusetts estate tax law does not have portability. So that does mean that if you're in, so for married couples, you don't want to just be looking at the spouse of each estate being under 2 million. You really want to, in terms of tax planning, be thinking about the combined estate of both spouses. But if the combined estate of both spouses is well under the 2 million, then it might not be something that you're worried about at this time, or any steps that need to be taken. Another category is single individuals who may be able to, well, single and married, but for both categories may be able to avoid estate taxes by doing gifting, which is something that Harry talked about, the basics of gifting and how under this new law it makes gifting even more potentially be able to save even more significant estate taxes in terms of gifting assets out of your estate prior to death. However, I would just add that, certainly important caveats on gifting, not something to do without talking to, whether it's a estate planning attorney or a financial a CPA. You'd want to make sure that if you are gifting assets, that you're aware that there are other tax consequences. Most importantly, the fact that gifting highly appreciated assets might actually put you in a much worse position, because even though you save on the estate taxes, your heirs might get hit with significant more capital gains taxes. So without getting into all of the details of that, it's just important to know not to just make significant gifts without seeking counsel and advice first before doing that. Finally, if you are in a situation where you're a married couple and your combined estate is greater than 2 million, you may want to consider doing a credit shelter or QTIP plan if you don't already have one, as this will, as Harry mentioned earlier, allow for you to now double your exemption from 2 million to 4 million. And so with that proper planning, can now pass 4 million to heirs tax-free. Estate tax-free. Okay, and then in terms of existing plans, so if you do already have a credit shelter QTIP plan, what do you need to know? First, if you're in the category of your combined estate is over that 2 million, most plans will still work, because in most plans, or at least the plans that we do, many of the attorneys that we know will structure the language of the QTIP credit shelter plan so that it's not tied to a specific amount. So it doesn't say, necessarily this happens to the first 1 million in assets. Instead, it's structured so that there's flexibility, because obviously we know that these exemptions may change over time, and so it allows the surviving spouse to make an election based on the exemptions at the time that first spouse passes. So therefore, in most cases, your existing QTIP plan will work in terms of allowing you to double the exemption, although it is something that is still worth reviewing with your estate planning attorney. One thing that may be important to consider is that when you did your plan originally, you may have been thinking that we only have to make sure that we have the first million going into the trust of the deceased spouse. So you might have, had life insurance, for example, and 1 million of life insurance going into each spouse's QTIP trust. And now that the exemption has gone up to 2 million, you might want to be thinking more about funding and maxing out that exemption of the 2 million per spouse. So that's in terms of if you're in that category of having that combined estate of over 2 million. If your combined estate is well under the 2 million, so maybe it made sense to do it when the exemption was at 1 million, but now doesn't really seem like it's going to affect you because you are under the 2 million exemption, it's probably still makes sense to keep your plan. First, just because it doesn't put you in a worse position in terms of having that QTIP credit shelter plan, and because there's other advantages of it. Of course, your estates also may grow over time, so even if it doesn't look like it will give you any sort of advantage now, it might in the future. And then there's also things like with our QTIP plans, probate avoidance, incapacity planning, second marriage protection. Those are all things that will still be to your advantage, even if your estate is well under that 2 million total.
Okay. Very good. Let's see if I can turn this slide. Yeah, I guess. Good. So I think we moved right along and got through all that. And now it's time to turn to the questions and answers. And we've divvied up the ones that we already got before we started. So I will start with the first one. It says, prior to the new Massachusetts estate tax, my wife and I maintained $1 million division in assets. Is there any need to continue that division now that the Massachusetts state tax is $2 million? It made the Massachusetts state tax threshold. So I presume that these people do have a QTIP or credit shelter plan. And it's really the question that Sarah just addressed. So if they're well under $2 million, they don't need to do that anymore. They may choose either to update their plan and revoke it, or keep it for some of the other benefits that Sarah just went through. But we're assuming that they had such a plan. They didn't say that in the question. They didn't just try to divide up their estate without a plan, which might not have done any good anyway at the time. Okay, Sarah, you're next.
Great. So next question is that if a couple has an AB trust and one spouse died in January of 2023, what is the procedure for adding an additional $1 million to the B trust if the estate tax and trust was already filed now that the new law in Massachusetts was passed? So I think this question is just going to a spouse passed in January of 2023, and everything was done assuming that the exemption was at the 1 million. Now that it's 2 million and that it's retroactive to January 2023, is there any steps that can be done so that you can now actually shelter that first 2 million? And so we have had some of these, already had some of these cases at the firm, and there are steps that can be taken, doing an amended estate tax return, and depending on how the trust is structured, making those, amending those elections as well. So that would be something that whoever was the attorney or accountant that you worked with to follow up with them about making those amendments to the estate tax return. And I think I have the next question as well. So the next one is that now that the Massachusetts estate tax law no longer excludes out-of-state properties, if a second home is owned in Rhode Island, approximately 500,000, would there be an estate tax in both Rhode Island and Massachusetts? So a few things. So first of all, would have to know that I'm going to assume that, for example, that there's 2 million of Massachusetts, or at least 1.5 of Massachusetts assets that it's even going to trigger a need to file a Massachusetts estate tax return. With respect to Rhode Island, since the only Rhode Island asset, assuming that the only Rhode Island asset is that $500,000 property, I'm almost certain, although we don't practice in Rhode Island, I'm almost certain there's no estate tax there. It's just the 500,000. So there wouldn't be a tax in Rhode Island. In Massachusetts, assuming that the total estate is over 2 million, you would pay that tax, but you would do that calculation that I had mentioned earlier, where it gets reduced proportional to the Massachusetts estate over total estate.
Good. So I have the next question, which is money in an irrevocable trust subject to estate tax? And the answer is it depends. So the two issues: one, who's the grantor of the trust? So if it's it's only going to be included if it's the grantor who passes away. If somebody else created a trust and you're the beneficiary, it's almost certainly not going to be in your estate. But if you created the trust and it's irrevocable and you pass away, whether it's includable in your estate depends on how it's written. It could have been written so a gift was completed at the time of the transfer, and you gave up all what they call indicia of ownership, basically all rights to income or to make any changes to the trust. then it was a gift at that point, and it will not be in your estate. But if you retain some powers, say a right to income, a right to what's called a testamentary power of appointment, to change who's going to receive the property when you pass away, and there's some other powers that could also keep the property in your estate, then it will be in your estate. And often trusts are drafted in order to keep it in your estate so that they do get a step up in basis when you pass away. So we'd have to give you a definitive answer, we'd have to look at your trust. And then the next question is also for me. Are there any changes in probate law? If we are under the tax threshold, do we still have to worry about probate? So first, this did not affect the probate law. Second, this I think is a good question to clarify the difference between taxation and probate. So probate is the process of moving property from the ownership of the person who died to whoever their beneficiaries are or their heirs are, hopefully under a will, and if not under a will, the rules of intestacy, which is basically the will the state has for you if you don't create one yourself. And that's probate. So the only things that go through probate is property that's in your name alone. Property that's joint passes to the joint owner. If you have a beneficiary designation, such as on a investment account or bank account or retirement account, or if you have property in trust, all that kind of property does not go through probate, but it's taxed. It's included in what they call your taxable estate to determine whether you're over the $2 million threshold and what the tax will be. So this new law does not affect probate at all, but you still may not have a taxable estate, but you still might have a probate estate if you have assets in your own name when you pass away.
Right, and you might not have a probate estate, but you might have a taxable estate. So
right.
Both of them.
On the other side of that coin, exactly.
Okay, and then the next question. So it says, how is a house that is owned joint tenants with rights of survivorship in Massachusetts treated in regards to calculating the size of the estate? If I own it with my girlfriend and she inherits it in its entirety, is half, all, or none of it counted for the purposes of my estate tax? This is a good question. So this is an example where there's no probate because it's jointly owned. In most cases, the default of jointly owned assets is that it would be half each person. So if the property is worth $1 million, 500,000 would be treated as being part of the decedent's taxable estate. However, there are some exceptions if, for example, so in some situations, if one person purchased a property and then added somebody else on what they would consider for convenience purposes as a joint owner. In those situations, it might be that the entire value is included in the taxable estate, which actually might be better for the survivor because of the fact that that would give it a full step up in value for capital gains tax purposes.
Great. I think those are all the questions we received in advance. Have we received any questions during the program?
Yes, it looks like we've got, it looks like we've got 10 questions.
Okay.
Let me see. Can you see them, Harry, if you click the question arrow?
Where do I click?
I'll start. On where it says questions under webcam, if you click the down arrow, I can start by reading some of these off. You see that?
No, I don't see
I
them.
can start by reading them. So the first one, it says,
okay.
Okay, I'll start with this one. So it says, does this apply to all out-of-state real estate, or is it treated differently when an out-of-state property is held in a Massachusetts-based trust? So that's a good question. So, so typically it is, if it's held in a trust, so if there's, so we'll give the example of Maine real estate owned in a trust, it's still going to be treated the same as if it was just held in the decedent's individual name in Maine. So the trust is not going to Still the same rules are going to apply in terms of the property value is going to be included in that total gross estate, and then it's going to be proportionally reduced. So having it in the trust or not, in most cases, is not going to make a difference. However, one thing to be aware of is LLCs. So LLCs are a little bit different. Often people will title out-of-state property in an LLC as a way, often for creditor protection. And so unlike a trust, an LLC, if you had Massachusetts LLC that owned, for example, a piece of property in Florida, that could actually have the effect of making it a Massachusetts business asset as opposed to an out-of-state real estate interest, which could actually mean more taxes due for that Massachusetts decedent's estate. So you have to beware of using LLCs to hold out-of-state property for that reason, that it could mean more taxes due on the decedent's estate. Okay, and let me see, next one. Okay, what happens if a Massachusetts resident puts the main house into an LLC? Okay, I think we just talked about that. So I'll skip that one. Okay, I'll give this one to you, Harry. Can you please expand on when a $4 million estate tax exemption applies to a married couple? I don't know if we significant.
So as Sarah said before, we don't have portability in Massachusetts. So what portability is a federal law that says that when one spouse dies, their surviving spouse can basically inherit their credit. So let's say what the spouse dies and they have a $4 million estate. And they have a credit of 12.9 million. Well, if they give everything to their spouse, there's no tax on this, on what you give to your spouse, then the surviving spouse can add 12.9 to their own 12.9, so have basically practically $26 million that they can give away tax-free federally. If, on the other hand, this first spouse dies and he gives his $4 million, say, to his children from his prior marriage, then he's used up 4 million of the 12.9, and the surviving spouse can only has about 8 million that she can add to her credit, so she can give away 21 million tax-free. Still a lot of money. And these, just be aware that these huge numbers will be cut in half after 1225, and then 12 people dying in 1226 or thereafter can only, they have a threshold of closer to 6.5 million. I'll keep getting adjusted for inflation. Still very high, and together husband and wife can exclude, will still be able to exclude 13 million or so, adjusted for inflation. But in Massachusetts, we don't have that. So if you have a $4 million estate and it all ends up owned by the surviving spouse, they'll have more than the 2 million. They'll have 4 million, and they'll have 2 million subject to estate taxation. So the way to shelter that is by setting up a trust, a credit shelter, a QTIP trust, which are just different versions of really doing the same thing, of splitting up the estate, 2 million each between the two spouses, and the first spouse dies. We don't know who it'll be, but whoever is the first spouse, their share goes into this trust, which can be for the benefit of the surviving spouse with some limitations on how the money is spent, but they're not very egregious limitations. And with those limitations, that QTIP or credit shelter trust will not be taxed either when the first spouse dies, because it'll be limited to $2 million, and it won't be taxed when the second spouse dies, because it won't be in her estate. So, hope I answered the question.
Great, thank you, Harry. Your sound was going a little bit off, but I think it was overall fine. So I think everyone was able to hear the answer. Okay. All right, the next question is sale of a residence of a deceased person. Are there any issues with the title if the property is sold before the decedent's estate tax return would be due? So usually, we deal with this situation a lot in terms of somebody's passed away. You have the 9 months to pay the estate tax, and so there's an estate tax that is going to be due, but the family wants to sell the property sooner rather than later. So there's a specific form that you can file with the Department of Revenue for release of the estate tax lien. So it's a form that you file, and you make an estimated payment of the estate tax that you believe will be due. So you say, we believe that the total estate will be about $3 million. So we're going to pay the estimated estate tax due, and then the Department of Revenue will issue this release of lien that allows for you to close before the estate tax return is actually filed, and then you still have that 9 months, or if you request an extension, the additional 6 months to actually file the estate tax return. That is in the tax actually can either be paid out of pocket if there's other out of pocket, meaning from the decedent's other estates, or you can also have it paid out of the closing proceeds. So if the real estate's really the only asset, we can also work with the family so that it's paid off of the closing, out of the closing proceeds itself. And then this next question is somewhat related. So this says, I spoke to the Massachusetts Department of Revenue on an estate tax return that I filed and paid a tax. They said we don't need to amend the return. They will automatically refund the tax in the order of when the return was filed. So I did also hear this. I know that some people in our office had talked to the Department of Revenue that they would be going back through those other returns to say, the return was filed, this amount of tax was paid, but now it's because of the lower, it returns back to January. However, in most cases, and this is why it relates to that sale of real estate, in most cases where there's an estate tax that's been paid, it's been paid because there is a sale of real estate, because of the fact that you have 9 months. So most of those return, payments that were made earlier in the year were often done for purposes of getting a release of lien. And my understanding is that in that situation, because you only made an estimated payment, the Department of Revenue has no way of knowing what refund to give you because they don't know the actual tax due. So you do still have to file a return based and provide that information to the Department of Revenue. If you were in a situation where, for example, you filed an estate tax return in October, say the beginning of October, you filed the return, again, the Department of Revenue is saying that they are going to automatically issue these refunds, although it still may make sense, depending on your situation, to file the amended return. Also, among other issues, they've given no timeline in terms of when that will actually happen. So,
and another reason you may still want to file a return may be if you do have a QTIP or credit shelter trust and you had allocated $1 million to that trust, or taken a QTIP election for the excess over, or whatever I'm drawing a blank on whether you take it for the million or the excess over, but anyway, you made a partial QTIP election, then now that you can shelter $2 million, you may want to revise that allocation.
Right. Yes, definitely. And there might be other, just other things. So it's just worth reviewing, I think, on that. And then this question, I think this might have been answered, but just to clarify, so it says, I recall reading a report from Attorney Margolis that Massachusetts cannot include out-of-state property and real estate. Could you please explain? So that was the DeSori case. So that was the blog on the DeSori case explaining why that there was a time period up until the new law when we were excluding that, treating that value as a zero value property. So let's see. Okay, I think this, if an estate exceeds $2 million only by virtue of prior gifting, then it seems that a Massachusetts estate tax return would still be required, but could be missed because there's nothing due. So yes, that's what we also discussed that. I think some of these questions maybe came through earlier. If out-of-state resident with Massachusetts real estate is out-of-state resident with Massachusetts real estate less than $2 million, would the non-resident still need to file a Massachusetts estate tax return to include all other assets and then end up paying Massachusetts estate tax on the prorated amount tied to the Massachusetts real estate? And the answer would be yes, assuming that the total assets of that person both Massachusetts and non-Massachusetts is over 2 million. So we have had situations, for example, we've had attorneys contact us where there's a Connecticut estate and they have a Cape Cod property. The Cape Cod property is only worth 300,000, but they have, they have other assets worth 2 million. And so in that situation, they are still going to have to pay a Massachusetts estate tax on that $300,000 Cape Cod property, even though that's the only Massachusetts asset.
And it'll be a pretty small tax, because if the tax is 25,000 and then it's only what, 1/7 of that, so we're talking a few $1,000s. The cost of doing the return is going to be a lot more than the tax.
Right. Yes. And often, I mean, it often comes up as, I think, Harry, as you mentioned, it often comes up when the person when they go to sell the property. So often because people are out, other out-of-state attorney might not even have it on their radar of doing that Massachusetts return for that small property, but it can come up at that time of sale. Before the new law, a non-resident might own Massachusetts real estate in an LLC to avoid Massachusetts estate tax. Does that no longer work? So again, going back to the LLC can potentially make a just as it works for there's the danger of bringing other assets outside of Massachusetts into your Massachusetts estate by doing an LLC. There is also the option of creating an LLC to hold the Massachusetts real estate to try to get it out so that it's not taxable. I would say it's definitely not a very black and white situation. At least my experience in terms of speaking with other practitioners, speaking with the Department of Revenue, is that there is going to be a lot of scrutiny on that LLC. Is it really run like a business? Is there income coming in? There's separate accounts, or is it a situation where it's just a vacation home that you put into an LLC and you're treating it like a vacation home? So it definitely is something that is worth exploring if you're in that situation. But again, there is going to be, scrutiny on that structure to make sure that it's really a business asset versus a real estate asset with just an LLC name on it. Let me see. Okay, so this is a good question. So if the Department of Revenue is refunding funds, how do you avoid them issuing a check to the estate of, forcing a filing of probate just to liquidate the check? So that's a good question. We've actually come across that before with not this specifically with the change of tax, but also with amended returns where there's no probate and then you get a check back. There's actually a specific form that you can file with the Department of Revenue, and they will reissue the check specifically to the heirs directly. So I don't know offhand what the form is, but you can either contact an estate planning attorney who can give you that form, or even the Department of Revenue directly. If you call them and say, you're the surviving spouse and you just need the check to be reissued to you, probably wouldn't be that situation if you're with the spouse, but in any case, you can do that to get around that probate issue so that you don't have to do a probate filing. I think that is all the questions, but let me just make sure that they're coming in here. Okay, so this one says, if a federal estate tax return due and no taxes due, do you need a specific release for real estate? I think the affidavit says no federal estate tax to be filed, and in fact, the Fed tax not attached to real estate. I don't know if you want to answer that one, Harry. So I think they're talking about a federal estate tax return is due.
So,
and do you need to do a release for real estate?
So a situation where it might be due is if your estate is over the $12.9 million, but you have deductions so that whether it's a marital deduction or charitable deduction, so you still don't have to pay tax. In such a case, you're going to be filing a Massachusetts estate tax return too, so you'll get a release of lien. So those are pretty rare situations, I think. So I think whether an affidavit would do or not, I think it's probably academic because you'll get the Massachusetts release of lien.
Right, yes. So I think you would be filing, so you would not be filing an affidavit that there's no filing requirement. So you would just file both if you had to do both Massachusetts and federal.
Right.
Okay, I think that's all we have. So we have contact information below if you have any other questions, but otherwise I think we will wrap it up for today.
Yeah, thank you for joining us. And as we said earlier, if you want to review any of this, we will be sending out a recording, which you could also forward to other people who weren't able to attend.
Great. Have a great afternoon, everyone.
Bye.